Hello, it's Thursday, June 7th, 2018. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terrell of Terrill & Company, and we're going to chat a little bit about the markets and investing. And Joe, we're at the mid-year point, and it has been a volatile year, but we've been talking about that for a while. Is there something that we're kind of missing right now?
Well, Steve, I think the underlying trend that is dominating the markets is interest rates and what's going to happen in the future to interest rates around the world. Now, we know that's not the only issue. We've got all these trade concerns and potential trade wars, a little bit of geopolitical problems, but I think the number one question on investors' mind continues to be interest rates.
That's interesting because Italy, they've got some issues over there, and their bonds just fell off, and the European market. Now the European Central Bank is thinking maybe we should start rethinking this quantitative easing we've been doing.
Well, that's true. Interest rates in Europe by the European Central Bank have been artificially held at incredibly low levels. A German 10-year bond only yields 0.5%. A U.S. government bond in the same maturity range yields very close to 3%. Historically, those yields have been very close to even for years and years and years. So you can see just how much the European Central Bank is holding down those interest rates. If, as you are correct, one of the governors of the European Central Bank this week said, perhaps we should stop this policy of buying up all the European bonds to hold those interest rates down. In economic terms, let's stop quantitative easing. That's caused another ripple in worldwide investment markets as people wonder, is the potential here we're going to see a surge in European interest rates? If we do, and a 10-year German bond comes back up dramatically in yield, in my opinion, our 10-year U.S. Treasury is definitely going to go up in yield. It's somewhat being held artificially low by buyers around the world buying the U.S. Treasury because the alternatives yield nothing.
So let's look ahead. Next week, the Fed is going to meet, and everybody expects they're going to raise interest rates. They want to normalize interest rates at 2%. How much more do you think they're actually going to continue to raise interest rates?
I believe that the Fed, no question, they're going to raise interest rates next week. This is on the short-term federal funds, which is the ultimate short-term interest rate, and everything begins to trade off of that. They will raise interest rates next week. I'm of the opinion they'll raise them twice more before the end of 2018, and they'll probably raise them at least twice in 2019. I think they're ultimately going to take that interest rate up to 3%, maybe a little bit north of 3% on short-term rates. That's due to inflation picking up, the world economy picking up, and the Fed belief that normalized is not 2%. That's what the economy was growing at a year ago. Not 2% inflation. That's where inflation, looking over your shoulder, is running. But if you look forward, you see inflation running closer to 3%. You see the world economy growing, including the U.S. economy growing north of 3%. That's why I believe the Fed will raise those rates the balance of this year and next year until they get short-term interest rates to 3% or more.
So we've got volatility continuing for a number of reasons. How are you positioning your portfolio at this time?
Well, you have to be incredibly careful and it's a decent time to be a little bit conservative, because interest rates ultimately set the alternative for what other investments are worth. And as interest rates come back up around the world, this desire of everybody to buy stocks because there's no other alternative, you could see that begin to fade, and you could begin to see investor interest in stocks fade in favor of maybe beginning to accept the higher interest rates theoretically that are riskless. Now that's as long as you stay with a very short maturity bond. I've felt for a year now, and I'm every bit as confident right now as I've ever been, that people that own bond funds and are in particular bond products that have exposure to longer term interest rates, they are going to suffer big principal losses when the long-term interest rates go up. They already have suffered mild principal losses this year of 3 to 4%. That has the potential in the next 12 months to be losses of 12 to 15%.
Oh, interesting, Joe. That's Joe Terrell, founder of Terrell & Company, independent wealth management with $760 million in discretionary assets under management. Joe, let's look again to the next 6 months and what's going to go on. And we don't know, but it's bound to be interesting, if only because of the volatility.
Yeah, let's do another update maybe in the next 30, 45 days, because I think we'll have some fresh news to report by then.
Okay. Thank you very much, Joe.
Thanks, Steve. Appreciate it.
And thank you for joining us.